Welcome to Life Settlement Option. In this video, I'm going to give you an overview of life settlements to help you determine if a life settlement might be right for you. My name is Zachary Taylor, and for those of you who are history buffs, yes, I am allegedly related to the 12th President of the United States, although apparently he was one of the least popular presidents, so if you just want to call me Zach, that's fine too. I am a licensed life settlement broker, and I'm here to help policy owners find the most amount of money they can get for their policy. What actually is a life settlement? We're talking about the sale of an existing life insurance policy to a third-party investor. A policy needs to be enforced for at least 2 years before you can sell it to an investor. Every policy has 3 assignments. There's the insured, there's the owner, and then there's the beneficiary. Now, oftentimes when you take out your own life insurance policy, the insured and the owner is the same person. But in a life settlement, what's happening is you're transferring the ownership to another party, and in turn, that party is going to change the beneficiary to be their investment fund. But you will remain as the insured on the contract because the life insurance policy is based on your life. In 1911, the U.S. Supreme Court passed a law allowing for the transfer of ownership of a life insurance policy to a third party. Now, life settlements didn't really come around until the mid to late 80s and really started to pick up more in the early 2000s as the baby boomer generation started to age. How does a life settlement work? The 2 things we need to shop the market are an illustration of your policy and the last 5 years of your medical records. Investment groups are going to review those 2 items to determine whether or not your policy prices for a settlement. Our objective is to get multiple offers and try and negotiate for more until we reach the highest offer we can find. If you decide to accept an offer, then that investor will issue a contract which you will complete, and in that contract there'll be a transfer of ownership form from your insurance company. They'll submit that to the insurance company, and after a couple weeks the transfer of ownership will be complete, and as soon as that is done, your cash settlement will be released from an escrow account directly into your bank account or via live check if you prefer. From that point on, the investor resumes payment on premiums, and they're responsible for paying them until the death benefit is collected. Now, there is an alternative option referred to as a retained death benefit. In this option, you can choose a smaller settlement now, and if your life ends within a certain number of years, your beneficiaries will retain some of the death benefit from the investor at that point. So sometimes this option is worth considering if you're not happy with the lump sum offer. How much is your policy worth? Of course, this is the big question for everyone. We want to know how much we can get for our life insurance in a settlement. The 2 main things that go into evaluating your policy is your cost of insurance and your life expectancy. This is why we need to order an illustration and your medical records to help produce these numbers. Now, if your cost of insurance is $10,000 a year and the underwriter thinks you're likely to live another 10 years, that means the investor is going to have to pay $100,000 in premiums to keep your policy going before they can collect that death benefit. Now, the numbers don't crunch that easily. We also need to consider the time value of money. 10 years is a long time to wait for an investment. They could have invested the money in something else, so they need to factor in enough of a return on investment for the numbers to make sense. And just to give you a couple of examples, these are ballpark figures, but someone with a 5-year life expectancy may expect to receive around 60% of their death benefit. If you own $1 million life insurance policy, that means in a settlement they'll pay you $600,000 to take over the policy. Now, someone with 10 years life expectancy might receive around 20% of their death benefit. So again, with $1 million policy, Maybe an investor is willing to pay you $200,000 today to take over the policy, and they'll collect the $1 million approximately 10 years from now. Each case is truly unique because the cost of insurance varies widely from policy to policy. So let us help you out. Now, who qualifies for a life settlement? Your policy needs to have a minimum of a $100,000 death benefit, and the insured needs to be at least age 65 or older or have been diagnosed with a terminal illness. 20 years is usually the longest life expectancy we get any offers for. So if you're 65 and you're very healthy, we may not get any offers, but we can certainly try. And the policies that are considered are universal life policies, whole life, and term policies where they're still convertible. And you can check your policy contract or call your insurance company if you're not sure if your policy still is convertible. Now, who should consider a life settlement? Folks who have policies where the premiums are starting to become too expensive or they can't fit it in their budget. This may be a good time to consider a life settlement to relieve you from having to pay that premium. Another scenario is when there's no longer a need for the coverage. A lot of people get life insurance when their kids are young, but now maybe their children are grown up, they're successful, they don't need this policy anymore. Also, business partners will take out life insurance policies on other partners as a buy-sell agreement if they've retired or sold the business. This is a great opportunity to maybe retain some of that investment by selling those policies. And then certainly an unfortunate case, a lot of people, their policy is about to lapse because they can't afford that premium. You really want to apply for a life settlement as soon as you can. We need a couple months to get it done, so let's start talking today. Now let's review a case study to help you get a sense of an actual settlement. We had a healthy male in his mid-90s, no terminal illnesses. He had a $950,000 universal life policy, and he'd used all of his cash value to help pay for the premiums for the last 10 years or so. His cost of insurance had increased to a point where it was now $48,000 per year, and because he had no cash value left, he was going to have to pay the full amount just to keep the policy going. Over the life of the policy, he had spent $640,000 in premiums, and he did not want the policy to go. So we brought it to market, and we were able to get multiple offers. We ultimately closed on an offer where he received $570,000. This was significantly better than letting his policy lapse and losing his entire investment. Let's review another case study. We had a woman in her mid-60s with stage 4 cancer and was given just around 2 years left to live. She had a $400,000 whole life policy, but her policy did not have the accelerated death benefit rider, which gives you access to some of your death benefit if you are diagnosed with a terminal illness. She wished to have living benefits for the remainder of her time, and she also had medical bills to consider as well. So she received an offer for $200,000 with a retained death benefit of $110,000. Now, this agreement meant that if she had lived beyond 2 years, the offer would decline $24,000 per year that she continued to live, as the investor would have to pay to keep the policy going. But in this particular case, based on the information she had from her doctor, she felt strongly that this retained death benefit offer was better than taking a full lump sum at the close of settlement. I wanted to talk about universal life policies because a lot of people own these and they can be very confusing products. Now, one type of product is called a no-lapse guaranteed universal life policy. These have fixed premiums from the day you start the policy until the day you pass away. So they're generally more expensive when you're younger. They usually don't have a cash value account. but the premiums stay the same no matter how old you get. So they can be very attractive in a life settlement because the premiums as you're older are a lot more manageable than some of the other universal life policies. Now, your more typical universal life policy has a cash value account that's either tied to a fixed interest rate, an indexed interest rate, or a variable product where it's invested in the stock market. Now, a lot of these policies are a lot more common. They tend to be set up where the premium's less when they're younger, but their cost of insurance increases as they get older. So they can become very expensive if you live a longer life. Let's review those universal life policies with cash value accounts, because most people have these. So when you started the policy, your premium was $15,000 a year. Now, usually what happens is about $10,000 of that will go towards your cost of insurance, and the remaining $5,000 will go to your cash value account. That cash value account will grow with interest over time, depending on what type of policy you had. And over a good number of years, your cash value account may have grown to $125,000. Now, the way your policy was set up was that you could continue paying $15,000 a year even though your cost of insurance was increasing, because as it surpassed the $15,000 mark, well, they started to use your cash value account to help pay the rest of the premium to keep it going. Now you're a lot older, your cost of insurance is $40,000 a year. That means you pay $15,000 and the remaining $25,000 will come out of your cash value account to cover that cost. But over time, your cash value depletes and now you have nothing. And the insurance company comes back with their annual premium and you're on the hook for that full $40,000. This is a common scenario, and it's a great opportunity to look at a life settlement because most people can't afford a $40,000 premium, but they don't want to lose all of their investment. A life settlement option may be a good one for you. Let's review the marketplace and how it works. There's approximately 30 different life settlement providers in the market, so you definitely want to go to more than just one life settlement provider to try and get an offer. Each life settlement provider is likely to represent multiple funds, and each fund has different levels of motivation. So one fund might be really interested in your policy, while another might not even make an offer at all. It's always recommended to get more than one offer if you can. Our job as brokers is to help shop the market and help you find the highest bidder so that you can walk away confidently knowing you got as much as you could from your policy. If you're interested in applying for offers, let's start with a conversation. I can give you a free appraisal over the phone with just a few simple questions about your policy and your general health condition. If it's sounding interesting, then we can order a policy illustration and your medical records to prepare your case for market. Now, most life settlements on average take about 3 months from start to finish. That's 1 month of collecting information, another to get offers, and then another to close. This process can be sped up if you participate in helping to retrieve some of this information. Other times people aren't quite sure yet if they want to do it and may take a little more time, and that's okay. Now, there's no obligation to accept an offer that we bring to you, and there's no cost to apply. So if you're on the fence, I encourage you to at least have a conversation, and let's go from there. So I really appreciate your time. Hopefully this was helpful. Let's connect. You can call me at 213-784-1481, or if you want to shoot me an email, zach@lifesettlementoption.com. I look forward to talking to you soon, and hopefully I can help you out. Take care.